Rising from the ashes of the 2008 financial crisis, WeWork quickly became a star of the startup world. Its founders realized commercial landlords needed new tenants, and newly unemployed workers needed a place to get back on their feet. Investors were enticed by this new co-working business model and its charismatic co-founder, Adam Neumann.
Adam was, part business leader, but part sort of spiritual life guide. He had the personality of a god man rather than a CEO. And I think that captivated a lot of investors. The vision that he was selling was legitimate, but the company wasn't able to execute on that vision.
WeWork signed long-term leases while providing short-term spaces to freelancers, but it was losing money. Big investors like JP Morgan and SoftBank were convinced the company would eventually turn a profit and pumped billions of dollars into the venture. Their financial backing helped the company to keep growing until they had more than 12,000 employees in 29 countries, and it was valued at $47 billion, twice the GDP of Iceland. WeWork branched out. It opened an apartment rental company called We Live, as well as a school and even a gym. Then in August, the company filed paperwork to go public, but that revealed the extent of its losses, $1.9 billion in 2018 alone. Potential investors also raised concerns over Neumann's behavior and unprofitable business deals. The negative feedback forced the company to cancel its IPO, but that left it in desperate need of money. It came in the form of a $9.5 billion bailout from its major backer, SoftBank. But the investment came with a price. Neumann was forced to resign with a $1 billion payoff, and more than 2,500 jobs were cut.
There's a buried story here that I'm surprised people don't want to tell more, which is an awful lot of people work at WeWork, and those people took mediocre salaries, as folks in startups do, and that's part of the experience. But they take that in order to get common stock, which is clearly very close to, if not completely worthless. And so a whole lot of people have worked very hard for a number of years to get nothing.
WeWork's woes have forced other firms vying for investments to rethink their business models so they can become profitable quicker.
You saw right after this whole thing, Lyft immediately came back and said, by 2021, we're going to be profitable, 1 year in advance. Uber saying we're going to be profitable. So all of a sudden, growth at any cost is not acceptable anymore. So WeWork on its way out, though they hurt their own investors, I think they left a nice trail in terms of really making the market more rational and more healthy for the future.
Together with Goldman Sachs, SoftBank is now raising another $5 billion. While this should help the company stay afloat, it will be much leaner. Analysts hope WeWork's fall from grace will be a cautionary tale for other businesses operating in the sharing economy. Nick Harper, TRT World, New York.
Well, for more on WeWork's woes, let's bring in Santosh Rao, Head of Research at Manhattan Venture Partners in New York. Good to have you back with us, Santosh. Now, a tumultuous year for WeWork. What went wrong for the former darling of the unicorns?
Yeah, so a number of things went wrong, starting with corporate governance. It's just the whole, right off the gate, they just lost the narrative. They positioned themselves as a tech company when it was not. They did not have all the ducks lined up in terms of financial transparency. Nobody knew what the unit economics were, and they wanted $47 billion, which is priced for more than perfection. So it just did not add up. So I think it was a case of badly managed IPO, badly advised, you can say, for against the bankers. They were not ready for an IPO. They didn't position it right, and the appearance of self-dealing, almost bordering on fraud by the CEO was just absolutely a no-no.
Yes, now, part of what made WeWork so successful was the billions of dollars that the Japanese conglomerate SoftBank poured into it. It seemed like the CEO of SoftBank, Masayoshi Son, was really captivated by Adam Neumann as the founder of WeWork. What lesson has SoftBank learned from all this?
Yeah, I think they are pulling back. SoftBank's learned many lessons, starting with Uber. WeWork, of course, was a bad extreme case, an outlier in many cases. But I think SoftBank has realized that you really can't spray money around. You have to go down to the basics, see what the companies are, look at the business fundamentals, and not just expect them to do well. I know the strategy in the VC world is to invest on average in 10 companies and hopefully 1 or 2 will work. That's fine when it works, but there are chances when all 10 can fail as well. So I think SoftBank has really gone back to the table, drawing board, and say, you know what, let's be more disciplined about where we do it, how we do it, be valuation, and then kind of not just expect the CEOs to do everything, monitor them.
Now, we know since the IPO for WeWork failed, it's faced a huge leadership shake-up, culminating in essentially paying off its founder, Adam Newman, so that he will no longer have any power in the company that he founded. Do you think WeWork will be able to move on from this and succeed as it had planned to?
Well, you know, at a very high level, there is demand for flexible space, flexible leasing and all that. It's really hardly penetrated. It's, I think, 1% penetrated of the overall leasing market. So there is demand, but how do you value them is a big issue. And that's where they went wrong. They thought that they had this whole thing mapped out. They thought the market had a huge appetite. Yes, there is demand for it, but that does not justify valuations, crazy tech multiples or tech valuations, and that's what they were positioning themselves as. So I think that was a big problem. So going forward, I think you'll see WeWork more. It'll come back. They have some good properties. I think they have divested of non-core assets. So I think they will be more disciplined financially. The management is much better. But we'll see. I think they will be a much different company and much more focused company. But we'll have to see. The demand is there. They just need to execute.
Few places have seen the sort of ups and downs that Hong Kong has witnessed over the past 12 months. As protests rocked the International Financial Centre, its stock exchange has tried to adapt to a challenging global market. Joel Flynn has more from Hong Kong.
3, 2, 1, hit!
As Hong Kong turns its back on 2019, investors here may feel the defining sound of the year wasn't just the riot officers' gun, but also this stock exchange gong. Anti-Beijing protests have shaken the city's political foundation, but the city's stock market has been resilient. Gains have been comparatively modest on the Hang Seng, but it was a different sort of return that was heralded in November. After debuting on the New York Stock Exchange 5 years ago, Alibaba launched its secondary listing here.
站在这里，我非常激动。
On our 20th anniversary, we come to an important milestone, coming back home to Hong Kong to list.
Alibaba raised $11.3 billion in the world's second largest fundraising of 2019, behind Saudi Aramco. Its success soothed worries that Hong Kong's image was being tarnished. The protests that began in the city in June have given investors pause. The Bank of England this month estimated $5 billion in capital may have been transferred out of the city as a result. That's had Hong Kong's leaders worried. A recording of a private conversation with Chief Executive Carrie Lam was released by Reuters in September. It revealed her concerns that China could strangle the offshore market.
They are willing to play it long, so you have no short-term solution. Hong Kong suffers. You lose tourism, economy, you lose your IPOs, and so, but can't do much about it.
But Alibaba wasn't the only large company to come to the rescue. The world's largest brewer, AB Inbev, listed its Asia business in September, though only after reducing its price, which had turned some investors off.
You can say the conditions are more challenging, but when we listen to the potential investors, we believe there is a solid excitement about this business and about this IPO.
The Hong Kong Stock Exchange was trying to do its bit as well, launching a $39 billion bid for the London Stock Exchange in September. That was canned just a month later. The other big concern, though, for the Hong Kong Stock Exchange has been the launch of China's Star Market, a new tech and innovation board, which threatened to steal business away from Hong Kong. By the end of this year, KPMG reckons Hong Kong will have completed 160 IPOs, raising almost $40 billion. Despite its problems, the number of main board listings will hit a record high. Analysts believe things may look different next year, though.
Given all the challenges that Hong Kong faced in 2019, I think it's done exceedingly well. People didn't lose money. It retained the top IPO market of the world. But I think going into 2020, if the situation don't get resolved quickly as possible, it wouldn't be as kind to Hong Kong market as it did in 2019.
For all the worries about the Hong Kong stock market's appeal, though, the business world, here as much as anyone else, will need a political solution. Joel Flynn, TRT World, Hong Kong.